All right, let's go ahead and get started. This is Monday, December 4th, 2 p.m. section. This class is being recorded. So here is the sign-in sheet for today. Make sure you sign the sign-in sheet. This will be the second to last class we do attendance. We'll do one today. And we will do one, on Wednesday. And so I did post this morning a link to the attendance tracker. So based on your section here, these would be all of the sign-in sheets. If you sign the sign-in sheet, it's just blank, you're here. If you didn't sign the sign-in sheet, then you were listed as absent. And if you sent an email asking for an excused absence, it was approved, then it changed to excused. All right. And so this will be relevant to the or final exam, because you can't have more than one unexcused absence and take the final exam. Okay? So if you think there's a mistake has been made, you're welcome to email me or see me about that. But nonetheless, this is based on the attendance tracking so far this semester. Yes?
Just remind us, is the final exam on the 11th?
The final exam would be 1 week from today if you're taking the final exam. So just as a reminder of our end of semester logistics here, today the assignment replacement is due. So if you're going to do the assignment replacement, it's a 500-word paper on NVIDIA, okay, with the principles from this class. By the way, last week I noticed somebody had submitted the assignment replacement. They submitted just an Excel file. And I sent them a message back to say, you're not going to get credit for that because the assignment replacement's for a paper. Like, you can give your Excel file to support it, but you still have to send the paper in is the requirement for the assignment replacement. Okay, so make sure you do that. 500 words. And by the way, word count matters in this class, as you know, so don't use Google Docs for your word count. Use either Word, PDF, or Elms directly. They all use the same way of counting words. But 500 minimum words, and that's due end of day today for the assignment replacement. It will replace any individual assignment, BMC Trading Challenge, assignments 1 through 11, or if you missed a peer review and got a -1. Okay, so any of those, one of those can be replaced. Right now, Wednesday, we have a lot going on. The next thing is the Bloomberg Trading Challenge ends on Wednesday. Okay, so looking in to the Bloomberg Trading Challenge. This is section 201. All right, so this is the ranking as of today. Everybody's met the requirement for 10 longs. Thank you for doing that. Everyone has met the requirement for not having more than $300,000 of cash. So thank you for meeting that. Remember, don't liquidate your portfolios on Wednesday. All right, so I'm just going to take a screenshot of the screen approximately 5 o'clock at the end of Wednesday after all the presentations are done. And then for the 4 sections, that'll be the final ranking where you end up on Wednesday. You're ranked on portfolio value. You can see it's a pretty tight race between first and second place today. One team's at 8.74%, the other's 8.56%. So that could swap places even the next 2 days. But the biggest thing you should notice is how different this looks than 6 weeks ago. Like, the first half of the trading challenge was a bloodbath. It was just really difficult. No one really made any money. Here, the entire class has actually got a return. Matter of fact, the worst performing team this class would have actually beat all 24 teams in the first 6 weeks of last semester. Okay, so it's just how important the market is. I talked about the first day of class. I said, look, half your performance is your market, your industry. That's why we did EIC. All right, and the market has been much better, and stocks have been doing much better. 6 weeks ago, we were worried much more about inflation. Over the last 6 weeks, when data's come out, inflation's now down to 2.5%, 3%. Right? Economy is still pretty strong in the GDP. And the Fed has basically said, because inflation seems to be taming, we're not going to raise interest rates anymore for the time being, and the market's actually predicting they're going to start lowering them again. We're seeing the yield on the Treasury go towards 4.5% versus 5%, or for the 10-year. And so you're seeing the market sort of expecting that inflation is going to be controlled And interest rates are coming down, which means cost of capitals have been going down. And if cost of capitals go down, that's why the market's been rallying the last month. And you see like 5 or 6 weeks of the market going higher. It's because, not that they're making more money, but those cash flows are worth more. That's playing out even in the trading competition. But nonetheless, we got 2 more days to go. Questions about the trading competition? Now to 5 o'clock on Wednesday. All right. The other thing that's due Wednesday is your 4th group case presentation on multiples. Right. So again, you're going to present the company that you did for your valuation project, plus you're going to pick 2 others in that industry. Right. So just remind me, what industry do you guys have here? Who are your companies?
Apparel.
Your apparel. Okay, so you'll pick 2 other apparel companies, right? And you can find them on either the BIX list or the analyst curated list. But as I recommended, I'd pick 2 other peers that are not hard to explain, right? But nonetheless, that's what you're going to do. You'll have 10 minutes. You know the structure of the format. Basically, you'll turn in your PowerPoint Wednesday morning, covering everything you're going to present, because if it's not in the PowerPoint, you won't get credit for it. Matter of fact, a team came up to me and said, we got dinged for saying the buy, sell, hold opinion wasn't part of our presentation, but we verbally said it. So why did you ding us? And I said, was it in your PowerPoint? They said, no. I said, that's exactly why I dinged you. Like, it's got to be in the PowerPoint. You got to support the data that you talk about in your presentation, right? So make sure you turn that in. 10-minute presentation. I'll grade 8 of the 10 points. You will grade one of your peer teams, as you have been, for 2 of the 10 points, okay? And essentially, for your 2 points, you'll grade 0.75. It's in the explanation for the assignment. 0.75 on the PE, 0.75 on the EV to EBIT, and 0.5 on the EV to revenue. That's your distribution, okay? I'll have a similar distribution, just with 8 points. But the whole idea there is that, you know, kind of the deal and the understanding, that'll be our kind of last physical day here together in class. That will be all day Wednesday. Any questions about that project? All right, so as I said, end of day Wednesday, you will turn in, you'll get that grade for that project. You'll turn in your peer review for the Bloomberg Trading Challenge. Okay, so that's due on Wednesday, end of day. Okay, so in addition to Bloomberg Trading Challenge ending on Wednesday, the peer reviews due that night. Make sure you turn that peer review in. On Thursday, the peer review for this 4th group case on multiples is due. Make sure you turn that in. And your group grade for the 2 points for the team that presented the previous day is due on Thursday. Okay, so by Thursday, everything has to be submitted, right? That's very important because Thursday night, late night, going into Friday morning, the TAs have committed to have all the grading done, and they will do 2 things. First, they're going to apply the assignment replacement. So if you did the assignment replacement paper, the TAs will apply it Thursday night or Friday morning once all the assignments are in. Okay. Again, the assignment replacement will replace the Bloomberg certification if you didn't do it. I don't think anybody didn't do it. It will replace any homework 1 through 11, or it will replace a missed peer review. You got a -1 on a peer review for not turning one in. It'll replace one of those. Okay. Now, once that assignment replacement criteria is in, then the TAs will move on. They'll download the grade book from Elms into Excel, and they will apply the opt-out criteria for the final exam. If you're able to opt out after all the criteria is met, then they'll put 10 points in to the final exam opt-out points. If you're not able to opt out, they'll put 0. They'll leave it at 0. Sometime midday Friday, around lunchtime, we will send an announcement that says check to see if you've opted out of the final exam. Then you'll just go into Elms, go to the final exam opt-out points. If you see 10, you're done. If you see 0, you will take the final exam 1 week from today on Monday. Okay? For section 201, you'll take it during the class time you're registered for. So for you, you'll take it between 2 and 3:30 p.m. The exam will open at 2, close at 3:30. It'll be online through Elms. It will be a 10-question multiple choice exam, very similar to the midterm, testing content. Now, I got a question that says, is it cumulative? And I don't know how to answer that other than yes, the whole class is cumulative, meaning we've been talking about key value drivers from day one, and that still applies to valuation and multiples. So, but nonetheless, it'll tend to be more focused on valuation and multiples, but multiple choice questions. All right, you'll take that on ELMS, individual exam, subject to honor code. You don't physically have to be here in this room, but you have to take it online during class time. ELMS will auto score it. At the end of the day, 5 o'clock, I'll show you the scores. All the points will be done for the semester, and then basically you can understand your grade, right? So what'll happen was I'll then download from ELMS into Excel the grade book. I'll basically just sum up all the points for all the assignments, all the midterms, all the group projects, and that point total is your letter grade, which I'll probably submit that following Wednesday on around December 13th, giving people a day or so if they have any questions I need to make any adjustments on. Okay, so a couple things. One, you'll know your grade to some degree by next Monday. Matter of fact, most of you will know it on Wednesday if you opt out of the final exam. And you should have a pretty good idea whether you're going to opt out of the final exam. Like, you know the same criteria we're using. You can see the same points we see. So you should have a pretty good idea of whether or not you're going to opt out, but you'll officially find out on Friday whether you're taking the exam. And then by Monday, you'll know your final grade. Remember, ELMS continues to mislead you. I got continued questions from the last 2 sections. You know, all this extra credit's in there. It's lowering my grade in ELMS. Yes, it does. ELMS was never designed to have more than 100 points across all assignments. We now have 105. By the way, I made a mistake, and I actually said one of the assignments was like 3 points and the other is 2 points or something like that. I had the wrong assignment, so I switched the point. But the point is, congratulations, you got an extra bonus point of extra credit. There's now 5 extra credit points, not 4, because I made the mistake. But I'm going to honor that and give everybody the extra potential point. And then, last but not least, 2 of my TAs are sticking around for the spring. We're looking for 2 more TAs. If anybody's interested in becoming a TA, pays $15 an hour. There's a submission link. Please submit if you're interested. You got to be registered to be at the school, so if you graduate, you're not eligible to be a TA. But nonetheless, 2 hours of office hours a week on Thursday, Friday, plus individual assignment grading and helping. From what I heard, you guys use the TAs pretty heavily this semester, and hopefully that was appreciated. I got another 180 students registered for the spring, so we're going to be overcrowded again. So nonetheless, definitely need the 4 TAs. Also, you're getting the university to require you or ask you to fill out a peer review for this class. Please do that. Okay, so please give feedback on the 443 in general. Always appreciate that. Ironically, you're not supposed to give those reviews until the grades, or you're not supposed to see your final grade before you give the review for the class, but you're going to know your grade on Monday, and I think the reviews are due by like Wednesday. So you'll kind of know your grade. Hopefully you're not just dinging because you didn't like your grade, but regardless, please take the time to fill those out. All right, so those are kind of our end of semester logistics. It's come very quickly. Questions about any of that? No questions? All right. I want to go here and talk about key value drivers. This was the file associated with an exercise we did near the beginning of the semester. We said, look, if you understand these 6 scenarios of key value drivers, we did this as teams, then you'll kind of understand kind of mostly what's happening with the value of companies. And that's been universal. It's not only through the class, but it's beyond the class. And these are just key important lessons. But I want to talk about it in terms of your group projects, particularly the valuation project, as well as the multiples projects, right? Because in a way, they're both based on the key value drivers, which is just a cash flow valuation of the company. When we do an enterprise DCF, and today for extra credit, you could have done the one on Amgen, just as an example, right? We did the 4 models, the as-is, the bull, the bear, the target, the write-ups. But the point is, when we did those valuations, okay, we forecasted 5 years, and then we made year 6 continuing value, the perpetuity value. Okay? This would have been a good multiple choice question. I don't know if I put it in the midterm or I'm going to put it in the final, but here's the question. How many years should you forecast out before going into continuing value? 3, 5, 7, 10, none of the above. How many years should you forecast out before going to continuing value? 3, 5, 7, 10, none of the above. What's the right answer? Yeah.
I would say none of the above because it depends on like the company's characteristics and its growth profile.
That is the exact right answer for the exact right reason. Because what characteristic is ideal to be in continuing value? What do we want to see about the company? It's not a positive spread. You can have a negative spread in continuing value. There's something else we're looking for to say a more legitimate. Yeah.
Like you want growth to like stabilize.
You want to be in a stable format, right? And so the point is, if we do Costco, we don't even need to go out 5 years. Costco's like a friggin' clock, right? They're just cranking out a few percent growth at a consistent margin, a consistent return every single year, okay? Walmart's easy to value. Target's easy to value. Heck, some of the companies in here, Nike, is probably pretty easy to value, right? Because it's pretty consistent, and we don't think Nike's going to fall off a cliff anytime soon. It's going to kind of crank out their earnings consistently over time, right? But so therefore, year 6 is probably going to be pretty reasonable for them being stable, right? Tesla, not so much, okay? Because if I want Tesla to be a stable, mature company, I don't think they're going to get there in 6 years. Like, despite, Elon Musk doing his best to piss off everybody and kill the company with his anti-Semitic stuff, like, take all that aside, Tesla has still got a lot of growth ahead of it, and they're still going to be probably in the growth stage in year 6. And basically betting year 6 into perpetuity on 3 numbers, which is really what the key value drivers are based on. 3 numbers represents 80% of the value starting in year 6. It's a big approximation. That's why we go out a few years before we do it, because we're hoping the company will be more stable. But 5 years is arbitrary in this class, just to make your lives easier. Tesla, I might need to go out 10 years, 15 years of year-by-year forecast before they're more stable. Costco, I could probably go out 3 years and I'm done. Okay? But we're just arbitrarily doing 5 for every class. Okay? That's very important, because if year 6 is not representative of a forever future, that could make our valuation challenge a little bit harder. Okay? Because we're just saying that whatever we are in year 6, that is the stable representative numbers forever. Okay? And that's why it's a proxy. It's not a scalpel, it's a broadsword. Right? All right, but that's what we've been doing. And I think you guys have been doing a good job kind of working through that process and understanding the process that we put forward. Right? When you do multiples, you're doing the exact same thing. The only difference is you're not forecasting 5 years first. You're just saying today times 0 equals the entire value of the firm in perpetuity. That's the biggest difference mathematically between an enterprise DCF and a multiple. We're just using this formula today. We're not forecasting any more years. And we're assuming whatever numbers we plug in represent forever. Now, I've told you that our process is to start with using Bloomberg and to start with the second forward year, because that's usually more normalized. So really what we're saying is wherever they are in the second forward year equals forever, right? And for most of the companies that we've done this semester, that works, but not all of them. And there lies the problem, okay? Because many of your teams forget to realize this. It's not just about solving a mathematical equation by just plugging in numbers and seeing what you get. I call that plugging and chugging. Like, we got to be understanding of what we see and why we see it. And if that second forward year, the numbers don't look like the perpetuity numbers that explain the value that you see today, then we got to adjust them. Because eventually we've got to tell a story with what we do. All right, so I'll say this, and I want to illustrate a point that happened in a different section. Okay? But basically, this team in their valuation gave models that had G's of 40%, plus or minus a little bit. Okay? and they scored very poorly. And they have been complaining to me, even through today, about how I could grade them so harshly for those 4 models that they submitted, all having Gs of about 40% plus or minus a little bit. Okay? Now, the first thing you should understand is these are perpetuities, which means in a perpetuity, cash flow divided by R minus G, mathematically, you understand that G can never be higher than R. Okay? It's not allowed mathematically in a perpetuity. And they submitted 4 models where that was the case. They gave me 4, in my mind, 4 invalid models. And I pushed back on them. I said, look, you have 8 finance and accounting majors who have all taken math classes. I'm surprised that not one of your 8 people on your team didn't realize that this was a mathematical problem. Okay? And you've submitted 4 invalid models, right? But that being said, I said, even if it wasn't an invalid model, because the problem is, if you go to perpetuity, where your G is greater than your R, what you're saying is for that level of risk, we're going to own the world. Because basically nobody's going to have any reason to invest in anybody else, because we're going to grow faster than everything else at this level of risk. And eventually in perpetuity, just take over the world. Well, this is not going to happen. So that's the first problem with the math. But the second problem is this. Take your company's revenue, multiply it by 1.4. Then multiply it by 1.4 again. Then multiply it by 1.4 again. That's what you're saying with a G of 40%. So if your company is like 300 billion in sales, by the end of the decade, you're like 6 trillion in sales when you compound that at 40% a year. There's no company on the face of this earth that's going to get that big this fast. So when you put that number in and you're trying to explain this, like you can't. It doesn't make even logical sense, even if you take the fact that it breaks the math. So I go this in a long way of saying it, is that as you work on your multiples, as you work on your PowerPoint presentations, whether it's in this class or the real world, just because you can solve for something doesn't make it right. And that's the whole point of there's understanding your assumptions. Like, why are we putting the numbers that we're in, and do they make sense, and can I tell a story out of it? So let me just give you an example of this industry today, the airlines, and 2 of the problems that they're having with the key value drivers. I said, okay, airlines, this is the class this morning, 11 a.m. section. What kind of cost of capital do you think these airlines have? And they're all around 8 or 9% in the industry. So I'll just use 8, keep it simple. Okay. Now, one of the companies has a PE of around 6 or 7. Okay? We have to get that number in B9 to 7, 6 or 7. How do you do that? And I'm telling you, we're not going to change the cost of capital in column B. So we're either going to change the G or we're going to change the ROIC. So what G ROIC combination gets you to a multiple of 6 or 7? How do we get there? Can I take a company like this and crank up the growth? That's not going to work. I can't have a big growth on a positive spread. That's not going to get me to a very low multiple. So that's not a scenario that's realistic. Now, can I have a negative growth rate of like negative 10%? Negative 20%? I mean, I might be able to get to some big enough negative number that I might be able to explain that spread. But is there any airline in the US today that's going to see their business shrink 20% every single year for the next 5 years? Is Southwest just going to lose 1/5 of their passengers every year for the next 5 years? Is Delta, are you that upset that you won't fly, that the airline industry is basically going to be gone in about 10 years? Is that going to happen? So just because I might be able to get some big negative G that explains this, is that realistic? You think that's really why this company has a low PE multiple? So why would this company have a low PE multiple? How do you get to a 7? Yeah. You do what to ROIC? Increase it? All right. So how fast are these airlines growing? What do you think? How fast do you think an airline's growing? Are they growing 10% a year, 5% a year, 3% a year, 20% a year? Like here's Southwest Airlines, which I think is representative of a U.S. airline. they're growing their revenue, which is row 13, 5 to 7%. So as you said, coming out of COVID, maybe those growth rates look a little higher because there's still some recovery to pre-COVID numbers. Although over Thanksgiving, I think they said that we had the highest passenger travel ever in the history of transportation in terms of people flying for Thanksgiving. But the industry has been recovering. Yes, sir.
Increase your cost of capital.
Well, let's say we're not changing the cost of capital because the risk is the risk. You could argue for an increase in cost of capital, but let's assume that the market's pricing the risk correctly. 8 to 9%, if they're all over 8 to 9%, doesn't seem like Southwest is that different than their peers. So what about the growth in the ROIC? Let's say I give perpetuity growth 4%. Now, why wouldn't I give them 8% based on the EEO screen? Because 8% is the next 3 or 4 years. Is that representative of forever? That seems a little high if I compound it ever. But just say you're growing the economy, 3 to 4%, long term. I'm giving them 4. How do I get my multiple down to 6 or 7? What's the only scenario that's going to get me there? Yeah. The spread's got to be negative. So the point here is you're going to end up with something closer to this. You're going to end up with a spread that's negative for some mid-single digit growth rate, because that's the only way the math is going to work, right? But let's think about what this tells you as a company, right? If you're worth 6 or 7 times earnings, and that's it, there's no value for this airline after year 8, right? So like it ceased to exist. Then it suggests that there's no long-term value. Well, why wouldn't there be any long-term value? Because the market's not giving you any long-term value because they think that the industry and your competitive position is not going to be great. That's why they're pricing you with a low spread, and that should be part of your story. And I'm telling you that if you see a low multiple, that's what's going to happen. If you see multiples in the low mid-single digits, what the market's saying is, I don't see a long-term value for you. If I don't see a long-term value for you, either you are going away, or you're just not really realistically earning a long-term positive spread. Like you might subsist and generate some positive cash flow to pay your bills, but you're not going to create any excess value that gives it back to the employees. You're not going to beat your cost of capital, and there's going to be pressure on your company over time. Okay, that's auto. For many of the companies in the auto industry, okay, that's what you're seeing in many of the airlines today. But one of the airlines, which actually was Southwest, saw a PE of 12. How does Southwest get to a PE of 12? So you got one airline that's trading at about 7 times earnings. You got another airline that's paying at 12 times earnings. How do you get to a 12? If you have a negative spread, can you get to a PE of 12? If my spread's negative, if my ROIC is 5, can I make this number go to 12? Well, if I crank up the growth, P is getting worse. I could have growth be 0 at negative spread. Now I get to a PE of 12. Now, is that realistic for an airline that's growing at 5 to 8% at Southwest? It's probably just going to be flat forever. Do you think the market is expecting Southwest to not have any growth in passenger volume forever? Is that a realistic scenario for Southwest Airlines? So if they're even growing at 2 to 3% a year, how do you get to a PE of 12? And the answer is 11. Whatever it is, I got to have a positive spread. So I'm telling you, when you get a higher PE company, 12, 15, 20, 25, it's going to be hard to get there with negative growth and negative spread, just intuitively, right? And when you see, because nobody's going to pay a huge amount of money for a company they don't think is going to be around, right? And no one's going to pay a huge amount of money for a company that's going to be shrinking themselves away. So that's the point. They have to grow at a positive spread. That's one of the scenarios, the key value drivers. And the opposite is true. If you have a very low multiple What it really says is nobody's giving you long-term value. Why am I not giving you long-term value? Because that growth doesn't have any long-term value. So at that point, I would expect that I'd probably likely have a negative spread. And if I haven't figured that out, then you're going to do really, really poorly on your assignments. Because that's the important thing I need you to understand. This has been the key value drivers since day one and goes beyond this class. So when we say make adjustments, this is what becomes key. And here becomes the next problem. If you do this mechanically and you just say, well, Bloomberg said the year two growth was this, and Bloomberg said the year two spread was this, and Bloomberg said last year's ROIC was this, and I use those numbers and I can't figure this out, then you're missing the point, right? It's a starting point. And as I said, for some companies, the second forward year looks a lot like the perpetuity, and it'll work. For other companies, the second forward year does not look like the long term. It won't work. We have to realize that, and we have to try and put in something that does make sense. So the point with Southwest Airlines is right now, in the second forward year, they're not expected to do well. So you get a low PE. But their actual PE is 12. And that's the teams they're struggling with. They're like, we can't figure out how to get this number to 12 because all the numbers from Bloomberg tell us it should be trading in mid-single digits. Help, right? And so that's why I'm using this example, because the whole point here is, I said, look, if you put in a reasonable growth rate, 2 to 4%, and solve for a spread, can you get to 12? Yes, but we'd have to turn the spread positive. I said, that's the point. Why do you think the market is valuing Southwest at 12 times earnings if their current forecast earnings don't support it? They have to have some belief that they're going to figure it out. Because long-term, Southwest Airlines has been a great company. And they've outperformed their peers for decades, right? So even though right now they're underperforming, the market is not pricing them as this underperformance is going to last. It goes back to that EIC. The market's pricing them as if their competitive advantage is going to return and they're going to improve the airline. They're getting credit for that in their stock price. So the second forward year is probably not where the full turnaround is expected to be. That's where we have to figure out the math to represent. And I'm saying, using the principles, the key value drivers, this is what you have to start thinking through. So if you run into a company that you can't explain, you have to make adjustments, or for purposes of your assignment, I made it even easier, pick a different company, which is easier to explain. But I'm telling you, that's why I spent more time on the 20% of the companies that don't fit the math very well, right? But we still got to explain it, because just like in the as-is models, we see real-world pricing out there. Pause, questions, comments about any of this. Are you guys, in this light, having any challenges with some of the companies that you are working on in the retail business? What company, when we did homework, was it 11 or 12? I don't remember. When I put the 3 retailers out there, what company did we say we had to make adjustments on? Why did we have to make adjustments for PVH? And what adjustments did we make for PVH? Was that homework 12 or homework 11? That was, I think, homework 12 extra credit. Nope, wasn't that. Must have been homework 11. There's homework 11. There it is. What adjustments did we make to PVH? And I use PE just because it was cleaner. What adjustment do we make to PVH? Yeah. Which one, I'm sorry? So if I look at PVH and I look at the forecasted ROEs, we had negative 80%, 200%, 0.1%, 4%, 7%. Why did I use 20?
You made it as a, you looked at the capital structure.
I'm just saying, I looked at the capital, but if you looked at any of those 5 numbers, could you discern a 20 out of those 5 numbers? No. At best, you could say, well, gee, after a couple of years, when they stabilize, they have low single-digit ROEs. And I'm telling you, if you put low single-digit ROEs into the key value driver equation, regardless of the company, you're not going to get a reasonable PE. It's not going to happen, right? You're going to get a number. Say I put in 6 or 7%. You're going to get a number like 3, right? So the question is, how do I get to their PE? I can't get there with this kind of multiple. Now I can start doing crazy crap with the growth rate, but as I go back to PVH, like if you do and you think it through, like, and I got like some negative 20% growth rate, like, does that make sense that they're shrinking that much every year? Not in perpetuity. They're not going away. Not as a retail clothing company. Not with brands like Calvin Klein and Tommy Hilfiger. They're going to be around for a while. So the question then becomes, how do I explain this? And what I'm saying is the way that we had to explain this is I knew that for any reasonable growth, the only way I was going to get that multiple up to 8 was that the market believed that that spread eventually turned positive. So whether it was 18%, 20%, 22%, I don't know. You can make some arguments, potato, potato, but I knew it wasn't going to be 6. I knew it wasn't going to be 8. It couldn't be. I can't logically explain that, and the math wouldn't support it. That's what I mean by talking about adjustments. Okay? Did we have to do that for Ralph Lauren? No. Did we have to do that for PVH? Yes. Can I give you a one-size-fits-all rule? No. All right? But can I tell you what to look for? Yes. And what you could start looking for is the key value drivers. So what I'm telling you is if you see the market pricing somebody with a high PE, it means high growth, high spread. If you see the market pricing somebody with a low PE, it means low growth and low spread. We start with that. And so that's why I said understanding those principles. We started early in the semester, and applying that as we go through this, really, really important. Beyond this class. Questions? Again, any challenges from any of your teams that you want to bring up? So let me ask another question. So you're grading 2 of the 10 points on this project. And let's say that in your grade, which I require to not only give me a number grade, but also a rationale for your explanation, your explanation is this. This team had many errors in their data in their presentation. And the grade was 2 out of 2. You say that the team made many errors in their presentation and you gave them 2 out of 2 points. How should I interpret that grade? What would be the rationale to say that and grade that way? They made mistakes, but I'm going to give them a perfect score. How would you justify that? Because I'm still trying to figure it out. I couldn't justify it. And so I didn't accept their grade. I penalized the team for submitting that. And I didn't apply that as the grade to the team that they graded. Because that's not a grade. Like if I just wanted everybody to just give everybody 2 out of 2 points because they did a good presentation, and doesn't matter what you say, I don't need to ask you to grade anybody. I could just give everybody a free 2 points, like the Tooth Fairy, right? But that's not grading, right? And that's the other thing. Like we don't grade in this class on effort. Everyone in this room worked your butt off all semester. You did 13 individual homework assignments. You got certified in Bloomberg. You did 5 group projects. and you took 2 exams. That's a heck of a lot of work. Plus, because of the attendance, you showed up for almost every class. So when you look at the totality of that level of effort, I don't doubt that everybody worked really, really hard this semester. That's why I let you opt out of the final exam. Because the only reason we have a final exam in this class is the university mandates that we have to have one. To be honest with you, from my perspective, I don't need a final exam to have an understanding of whether or not you understood the content. If you did all the assignments that I just talked about and you did well on those, you know this content. I don't need an exam to tell me that you know the content. All right, you know the content by all the work that you put in. Now, because the university makes me do a final exam, I have a final exam next Monday, and so basically if you didn't put the work in, that's why you missed one of those criteria, you're gonna have to take the final exam. But even if you take the final exam, you did most of the work, it's less about your final exam score. I think you actually probably know most of the content. But academically, if you take the final exam and you get all the answers wrong, even with what I said, I still can't give you a perfect score. I can't say, I let you take an exam, you missed all the questions, but you worked really hard this semester, so I'm just gonna give you a perfect score anyways. What's the point of having an exam? So I say that because we do take grading seriously, and so when you do these 2 points on the other teams, please take them seriously. It's also true of the peer reviews, okay? Because the whole point of the peer reviews is 50% of your grade is based on work that I don't see, right? Because you're working as teams and you get a team grade. And I'm not there for the group chats, and I'm not there for the team meetings, and I'm not there to figure out who put together the spreadsheets and who got the data and who did the write-ups. I don't see any of that. I only see the final product, which I grade. But that's the point. Everybody's going to get credit equally for that presentation. And if you didn't work on it, and you didn't show up in the group chats, and you didn't put in the effort, why should you get the same grade as everybody else? As a matter of fact, if you took credit for the work that you didn't do, it would be like turning in somebody else's homework and saying it was your own, right? That's an academic violation at the university. So the same is true with peer reviews. That's why I require the peer reviews, right? And it's your responsibility to tell me, like, if everybody did the work, okay, everybody gets the group grade. But if people didn't do the work, they shouldn't be entitled to the group grade. So that's the same thing. Like, we should be taking the peer reviews very seriously. And if you got peer review down, that's on you. That's not on your teammates. Because the point is, the teammates are saying, like, look, if you didn't show up, that's the reason why you got a negative peer review. It's not because they don't like you, right? If the reason that they gave you negative peer review is they didn't like you, that's going to be very bad for them, okay? Because that's not a basis for grading at the university. Just like giving somebody full credit when you acknowledge that they made mistakes is not a basis for grading. So as you fill out these final peer reviews, what I would just tell you is if you're worried, given what I just said, that your team might peer review you down, my advice to you, start talking to your team. Like, that's usually where the peer reviews come from. The peer reviews that I see on the negative scores for the peer reviews for lack of effort are what I just said. The people who never showed up, the people who didn't do anything, the people who sat there and let their teammates present while they sat in their butts in a corner and didn't pay attention to anything. Like, those are the people that get negative peer review down and should, because they didn't do the work. Now, I will also tell you that regarding peer reviews, it takes more than one. Meaning if one of your team members gives you a negative peer review, I don't change the grade. It takes 2 or more because I require cooperation, because I wasn't there. I don't see this. But I'm telling you, if 2 of your teammates say you didn't fully participate or more, your grade's gonna get lower, right? Now we got 2 projects left. You got 2 days left. It's not a lot of time. But if you think you're in that danger, again, my recommendation, start talking to your teammates, right? Because there's still some time to put in some effort if you haven't been putting in the effort. Questions about any of that? Questions about the adjustments we're making? Questions about how we're thinking about even the grades for what we're adjusting? All right, so the last point I'll just make in this context, which is pretty straightforward, but you know, for your group projects, make sure you're all working together. Make sure that when you're doing your 10-minute presentation, if you're making adjustments, start with that. I use these numbers initially that I got from Bloomberg. They didn't make sense for these reasons. We adjusted them to this for these reasons. Then This is why they're trading at a premium or discount to their peers. Okay? That should be your part of your presentation on Wednesday. Okay? I wouldn't go straight to the premium or discounts if you're making adjustments. And I wouldn't take numbers that don't make any sense and then try to explain premiums or discounts. Because if you have invalid or crazy numbers and then you're trying to compare them to the peers, then your presentation is essentially meaningless, right? Because just making up random numbers and comparing random numbers against other people is not what this exercise is about. We should have semi-realistic numbers, and that's the reason why you're trading at a premium or discount. So adjustments, if you have to make any, who you made them for and why, then premium or discount, cover EV to EBIT, EV to revenue, and PE, all in 10 minutes. So I'd also recommend practicing. Yes?
Since a lot of the reasons sort of fall under like explaining, so then like they do multiple things and those main parts of like factors in PE and factors that EBIT, can we just like increase them at the beginning and then like keep referring back to that?
When you say they do multiple things, what do you mean by they do multiple things?
Like, let's say one of their brands, like we focus on something that's having extreme growth, we can make the case that like that's what's increasing maybe ROIC and ROE.
Absolutely. So here's something I wish we had more time, but you guys worked pretty hard, so I didn't make you do this semester. But in a previous semester, we did CVS. And it was a little different because we did CVS for all 4 projects. Okay, same company 4 times. Right, this semester I kind of varied it, where for the last 2 projects you could pick your own and do some choice. There I didn't give them any choice, they had to do it. Okay, but this is kind of real world, so I think it's an interesting example because it played out. Where is it? Oh, here it is. Options. Make it a little bit bigger, easier to see. All right, so if you click here on CVS's peers, first thing you'll notice is it's got 3 businesses. All right, so if you actually understand CVS, CVS is not just your retail drugstore. That's a bunch of their sales. CVS also bought a company called Aetna, which is like 70, 80 billion a year. They're an insurance company. And then CVS is also in drug distribution. I'm sure many of you don't get prescription drugs, but if you ever do, like there's CVS Caremark will basically be the middleman between the pharmaceutical companies and the pharmacies, and they will basically buy the drug from AbbVie or Merck and then sell it to you by selling it to CVS or Walgreens or whoever your pharmacy is, and they have a third business, drug distribution. So there are 3 businesses that are added into one, okay? So they got managed care, which is Aetna. They got their food and drugstore business, which are like the grocery stores. And they have their supply chain distribution for healthcare business. You add them all up, you got CVS. So when you do a multiple analysis of CVS, you're really kind of doing their 3 businesses. But the reason I bring this up is if we just look at historical spread, ROIC minus WACC, just to keep it simple, okay? The average ROIC minus WACC for CVS is 7%, right? And the average of this group of peers is 13.8%. But if I just look at food and drugstore peers, the average ROIC for the food and drugstore business is 4%. Walgreens is -8, and I don't even know who Hims and Hers Health is -12. But the problem is that CVS and Walgreens, and to some degree Rite Aid, which is in bankruptcy, is not doing well when you basically go there to buy milk. All right, they're almost losing money. All right, so that's not how they're making 8% of CVS and 12% as a company. If I look at the peer group for managed care, these are the insurance companies. The payers, the insurance company payers, are averaging an ROIC of almost 14%. And there's only one company on this list that's making less than CVS, which suggests this is a far more attractive industry when I sell you health insurance than when I sell you milk. And then we have a third business, which is the supply chain. And this business is making 19. Okay? Now, here's the point. CVS is averaging 7 because they're an average of the 3 businesses. And if I were internal to CVS, I could see my actual returns for the drugstores, the actual stores. I can see the returns in the pharmacies. I can see the returns of the managed care, the distribution. But even externally, I can infer what those numbers are before I talk to CVS. Like I would know based on how horrible people are doing at Walgreens and at Rite Aid, that the CVS pharmacy physically going in to buy one of the 20,000 products on the CVS store shelves, it's a terrible business. And it's weighing down their business. And so that's the point. The business is the weighted average of the 3. Now, when we do multiples, we're doing that weighted average. But back to the point, if one of those businesses they're de-emphasizing, so what does CVS actually said they're doing publicly? How is their strategy adjusting in the future? What are they doing? Does everybody know? This would be important if you did a valuation of CVS. What are they doing in the future? Because it's about the future, not just today. Number one, they're closing stores because they're realizing that having a bunch of corner stores that are not making money is not helping them. So they're closing like 500 CVS locations. And CVS is going to become a little less convenient for a bunch more people. Anybody else know what they decided to do that they said publicly? That where possible, they don't care about selling you milk or bread or Tylenol. They are making their stores health hubs, kind of like minute clinics, right? So the point is they want to be more like a managed care company going forward and less like a grocery store going forward. Well, if you remember, the managed care business is making 12 to 14%. The grocery store competitors are making 3% or losing money. So it doesn't surprise me that CVS is like, why do we need a bunch of sales on candy and gum and milk that doesn't make us any money? We need to basically get you coming in there for the pharmacy business and the healthcare business, which is making money. And that's the transition that they've actually said publicly, is they are emphasizing more of that in the future, the higher returning businesses, and they're de-emphasizing the low returning businesses and they're exiting. Now, this makes perfect sense when you think about it in the context of the key value drivers, but I'm saying it shouldn't be a surprise. And if we were doing a valuation, then we need to understand that if they actually pull this off, then that ROIC is probably not going to be 8%. It's going to be higher in perpetuity. So if the analysts were to give CVS credit for moving into more attractive markets and getting out of the less attractive markets, then that 8% ROIC would not be the one to use in perpetuity. It would be higher. Now, how much higher? You can argue about, but it would be higher. And that higher return at some level of growth should actually give them a higher multiple going forward. That's the way we should be thinking about something if we were doing a valuation. Now that's more advanced than I asked you to do the semester because we're not clicking down to the divisions of your company. But if you were thinking about the divisions of your apparel companies, that's the case as well. So if I have a part of my business that's digital, omni-channel, that's growing a lot faster, that's not making money now, but omni-channel is the future of retail, and the market thinks that that's eventually going to be a very key source of cash flow and profit, maybe I give them a higher credit for it than they're earning now, and maybe that higher return in the future because it's much cheaper to sell online than it is in physical stores, and you need less inventory to do so. So that actually gets me higher rates of return, and I'm giving you credit for implementing some of that stuff, says Nike. By the way, why would I say that about Nike? Where's my Nike team? Who's doing Nike? I know you exist in this room. So what's important about Nike's future?
Growth of Nike Direct.
And how much of a percentage of sales is Nike Direct today?
I believe it was like 30.
And how much is Nike Direct going to be over time? I think you even said this in your GCF presentation.
A little more than the majority.
Over 50. So that's the whole point. If Nike Direct is going to be over half their sales in the future versus about a third of their sales today, then that's going to help Nike's performance over the long run if they can pull it off. Because they eliminate a middleman, they eliminate a spending on stores and capital, and they keep more of the margin for themselves, right? And if they can get their high margin shoes directly sold to you, that's just a much more profitable, much more high ROIC business. So that's the point. If I'm giving credit for that, they haven't seen that today, their future returns might look much better than their current returns, as good as they look, right? Now, I could also make an argument that they're not going to pull it off, and people are going to still want to go to physical stores to buy shoes, and they're not going to get the 50% anytime soon. And that's just a different model going forward. There's your bulls and your bears. But the point is, those are going to be the catalyst for driving it. But understanding the underlying business is the story behind why the multiples are higher or lower. By the way, if I look at Nike, up here, if I remember, Nike's multiples are pretty high. The wrong screen. I wanted to go to the EEO screen, and it takes longer to do their competitors. But the point of the story here is that if you look at Nike and you look at their PEs, try to get to a 23, 26, or 31 PE using key value drivers. You need very high growth and very high spread. It's the only way you get to that type of PE. Right? That's what I expect you to be talking to me about when you do your multiple analysis for why they have a high PE in 2 days. And if you came in with numbers that didn't support that, I'd be like, what? Huh? This doesn't make any sense. Questions, comments? All right. So what I want to spend our last few minutes on today is a little bit of a review. On Wednesday, which will be essentially our last day of class, you're going to do your presentation and want to get the heck out of Dodge, and I appreciate that. So we're not going to have a lot of time to do a end of semester review. So let's do one today. First thing I want to point out is we started the semester on 4 cornerstones. And we said this was the basis for the book, and this is the basis for what we're going to talk about. And they never changed. It was ROIC against cost of capital. ROIC is a proxy for free cash flow. It was about cash flow, not income. That's why we spent so much time converting statements, which you probably hated, to the economic format, which is a much more cash flow driven format than the income driven format of the accountants. It's about the future, not the past. That's why we use Bloomberg pretty heavily to get a understanding what people think those future cash flows could be. And we talked about the sustainability of Advantage, because whether we're looking at Nike or any other company, how long can they maintain the growth? How long can they maintain that return? When do they become mature? You know, all that stuff matters when we started to do all of these valuations. Now, the first section of the class, we started talking about key value drivers, and that's been universal, right? For the very first week of class, these key value drivers that explain value are not just for this class, but beyond. We talked about the external market being half your performance. We saw that clearly in the Bloomberg Trading Challenge, by the way, first half versus second half, and whether companies actually can have advantage. But we then define G and free cash flow. But more importantly, we then got into the first section of the class, which was EIC. Right? And when I started talking about the beginning of the class, E is very important to valuation. What are interest rates? Interest rates are going to be driven by inflation, economic growth, how big is the market, GDP 4 to 5%. That's been helping companies, right? Rising tide, bigger pie, there's more money to be made, okay? Industry, we use the 5 forces model to explain the industry, right? And the 5 forces model is just a useful way to explain the spread, right? Because we need to know not just it has a positive or negative spread, but why? Why does it have a positive spread? Why does it have a negative spread? What would cause that spread to change over time? That was the whole reason why I had you do 5 forces analysis. And then competitive advantage, which is, you know, are we just going to kind of ride along with everybody else? Are we going to be better? Are we going to be worse? What will change that over time? I mean, are you Adidas, where you basically bet the future of your brand on a Nazi-loving bigot? who says this publicly. Like that's what they did with Kanye. Like they bet their entire brand on Kanye, and he goes out there drawing swastikas and saying all this evil shit, right? And it's killing the company, right? And they should have realized this early on. Like you actually read the stories. He was doing this stuff internally to them. That when this went public, and you're a German company, and the guy's drawing swastikas everywhere, draw a swastika in Germany, you go to jail, right? And so that's the point. Like this is very sensitive stuff, and this is the guy you're putting as the face of the franchise. He put them in a hole, right? They got a bunch of shoes nobody's wants, but they got a damaged brand and reputation they got to dig themselves out of. Now, the market's not disputing that they're eventually going to dig themselves out. The question is how long is this going to take, and how painful is it going to be, right? To clean up the mess that they made, right? But that's the competitive advantage part of this. Like we can disagree on whether or not it's going to happen. It's the time frame that matters. Same thing, like in the economy, talking about Tesla. We're talking about the challenge with electric vehicles. But at the end of the day, we're moving to sustainable transportation. It's just a question of how long we're going to get there. In the US, if the Republicans are in charge, it's going to be a lot longer. If it's the Democrats in charge, it's going to be a lot faster. But you'll notice, whether you're Republican or Democrat, they're not saying we're not moving towards a sustainable future. It's just a question of how long it's going to take us to get there. And that's the point. Like we should understand that there are trends out there that are going to be important to the companies that we look at. Now, obviously, you can argue about the trend and how important it is, but still a trend, it's very important that drives it. That's why we have these EIC conversations, right? We then went in the second section of the class. Let's see if I can open. And we looked at the past. And a lot of what we've been doing, McKinsey does, is based on Modigliani Miller. That's a graphical representation of Modigliani Miller. Okay, it's the 4 buckets: operating, non-operating, debt, equity. You probably hated having to learn that new language of how to convert statements into that format, but I hope now, 2 months later, you appreciate what it's allowed us to do. All right, it's given us a much better way to talk about the value of companies. It's much more straightforward. And it's a step most people don't do. They skip this step in the real world, right? But I think that there's a value to this step and a value to tying the cash flows to this step, which was this graph that we showed you, and we did those conversions, because what it allowed us to do is to create 2 ways to look at a company historically. One was the ROIC trees and the drivers of ROIC. Starbucks was one of the examples. And 2, a CFI basically statement, which gives us a better understanding of what's happening in the company. And this was a jumping off point to the third section of the class. This is how we forecasted. Okay? This is how we forecasted the cash flows of the company, and it gave us a consistent framework to do that for the companies. And that's where we got into the scenarios. Because we deal with the future, we deal with risk and uncertainty, and there's not unanimity. Matter of fact, if we're talking about Nike, just another example, there's 2 sides of the company that matter. Okay, we talked about this as well. There's a group called the buy side, and there's a group called the sell side. The buy side, very important, are the owners of the company. They can be seen on a Bloomberg screen called HTS. Okay, Bloomberg tracks institutional ownership for publicly traded companies, right? And so basically, if you look at Nike today, 9% of the company is owned by Vanguard, 7% by BlackRock, 5% by State Street. Capital Group owns about 2%. Morgan Stanley owns 2%, right? But this is important because 9, 16, 21, 23, 25% of Nike are those 5 institutions. They control a quarter of Nike stock, which means they have very important impact on their board, and they pretty much are price setters because when they trade big blocks of stock, it's going to drive the stock price. So keeping these people happy is really, really important from a Nike standpoint. That's why I told you there's 2 earnings calls. When a company has an earnings call every quarter, the first earnings call is with the next group of people called the sell side. The second private call is with the owners. And what they hear on that earnings call is going to decide whether or not Vanguard wants to trim or add Nike to its portfolio. If they trim the portfolio, Nike stock's going down, okay? Because they just own too much of the company. And if they don't like what the company does over time, the board can get a little changed because they can start voting on new board members. They can throw your board members out and put new board members in. And the board's very important. If you just saw the big fight that happened over Thanksgiving with OpenAI, it shows you how important a board is. And if the board and management are not aligned and the board and ownership are not aligned, bad things can happen to a company, right? Regardless of you think how it played out. So I'm just saying, these are very important people. These are the buy-siders. What we said is the problem with these buy-siders is because they own so many companies, they spend a lot of money with these other group of people who are the specialists called the sell-siders to tell them what to do. The writers of the buy, sell, hold opinions, right? And notice even today, there's 27 buys, 16 holds, and 2 sells on Nike. There's not unanimity amongst the specialists, right? And that was one of the other points because we're dealing with the future, right? And there are different ways the future can play out, right? Watch Interstellar, right? So the idea here is there's also another element, which we didn't even get into this semester, about the political nature of these buy, sell, hold opinions, okay? Because there shouldn't be politics, and we've taken them at face value, but there are politics involved, right? And I'm just telling you, here's what I mean. Let's say you're Wells Fargo, right? And the Wells Fargo analyst has a buy recommendation on Nike. And Nike's about to do a big bond issue, and Wells Fargo is interested in being that bank to lead the bond issue. Well, is this really a buy rating because it's a buy? Or is this a buy rating because it's a hold? But if I give it a hold, it hurts our bank's ability to work with Nike, right? Because I'm telling you, if you're basically giving Nike a sell rating at JP Morgan, just making this up, and Chase is trying to work with Nike's CFO about doing more business with them, it's like giving them a big middle finger, right? And then you think they're going to want to work with you? So I'm just saying there's a political aspect to this where sometimes these ratings are a little bit softer than they probably should be because there is some political sensitivity to working with the companies themselves. I know it's not the way that's supposed to happen, and no one would publicly say that this is working this way, but it does, right? And so that's the point. That's why when we look at these rankings, we also have to realize in the real world, some analysts more than others. They matter more, okay? And so that's the next level of this class, which is who are the analysts that everybody respects? Who are the analysts whose opinions are the most trusted? Because those are going to be the lead steers. And who's the ones that are less respected? Because those analysts will give an opinion and don't anything have impact on the stock because nobody cares about their research, right? Because nobody respects it. And so there's those nuances as well. But what I'm telling you is what will make you good if you ever become one of those analysts is basically giving good assumptions that you believe that are explainable. Tell a story that is realistic. And you can tell an upside story and a downside story. But eventually people are going to respect you if you can give credible stories based on the academic stuff that works out in the real world. And so that's what we're aspiring to in this class, which is where we stopped. But nonetheless, we did the valuations. And then we talked about what the next step of valuations is, which is the multiples. There's another form of valuation. But nonetheless, I just wanted to reiterate this because I wanted to thank you. Like at the beginning of the semester, on the very first day of class, I was a little hard on everybody because I was hoping with 180 people, maybe like 20 people would quit. And I think I lost 2 people, right? So it's a testament to you guys that you stayed and you worked your butts off. You did all the assignments. There's a lot of them. You put in the effort. It shows. We can have conversations like we're having now and you're tracking everything I say. And the opinions that you give in your group projects are actually pretty reasonable for the most part. So it shows me that you learned a lot. And I hope you feel that you learned a lot in this class. If you're looking and you don't graduate for another class, I would just recommend Sarah Cronke's class. Is anybody here taking Sarah's class? So what is Sarah's class I'm talking about?
I'm in the SEMBIT fund class. I wasn't sure if you're talking about her master's class.
Well, you got no, there's an undergrad class, 448F. Is that the Summit Fund?
I think it's either 448 or 449.
Yeah, 448, 449. So what's going on with the Summit Fund?
Pretty much like student investment group here. Like we each cover the sector. I cover communication services, and the types of model we build. It's kind of like along the same basis, but like we kind of go a lot more granular into it, like each individual line.
Yeah, so basically think about it as the Bloomberg Trading Challenge, just real dollars. Like what's the Summit Fund today? Like 50 million, something like that?
Yeah, I think on the books it's like 2.5, but
No. Or what's the actual value?
no,
Okay, for some reason I thought it was bigger. Maybe I'm thinking about the MBA version of the class. But the point is, it's real money, and the students actually make real investments. Now, you're guided by Sarah so that you don't do something really stupid, because if you basically lost a quarter of the Sembit fund's value because of a bad recommendation, she'll probably get fired. But so she's not going to let you do anything crazy. But imagine you're doing what you did for the trading challenge with real dollars. But the important point is Sarah was a Wells Fargo analyst. She was a sell-side analyst, came into the school, and what she does, as he just said, she goes a lot deeper, right? I teach you how to value a company in 10 minutes, kind of 80-20. She spends the entire semester on one stock. She goes through every footnote. She shows you how to go through the footnotes. Look at every nuanced nook and cranny that you can find to actually get a more detailed valuation. So if you're just interested in this stuff, I think that's a good next step if you're a junior or trying to do something for next year to look into. It's a great opportunity. If you're graduating, congratulations, good luck. Hopefully it works out for everybody. So again, I'm just doing our final end of semester wrap up today. So where is the sign-in sheet? All right, please sign the sign-in sheet if you haven't. Okay. Otherwise, look forward to your presentations on Wednesday. Have a good day.